everyone, and welcome to the third and final instalment of QuotedData's Around the World Investment Trust webinar series, where we'll be looking at a selection of UK funds and speaking with their managers. My name is Jane Rana, and I'm an analyst here at QuotedData. And today I'll be joined by Harry Nimmo, manager of Aberdeen UK Smaller Companies Growth, Samantha Brownlee, co-manager of Dunedin Income Growth, and James Goldstone, manager of Invesco Select Trust, the UK equity share portfolio. I'm also joined this morning by James Burns, who co-heads Smith & Williamson's managed portfolio service and leads its multi-manager team. James, did you just want to start off by just sort of summarising what you do at Smith & Williamson?
Okay, yeah, I've got several hats on. I've headed up the investment companies research for the firm for 16, 17 years. As you mentioned, we run three small unitized fund of funds, which are primarily focused on investment trusts. And also head up the managed portfolio service, which has a mixture of open-ended funds, passives, and investment companies in there. So investment companies and investment trusts are an important part of my life.
Brilliant, thank you. We'll dive straight in then. First of all, a question for everyone. The UK has been unloved for some years now. Is this changing? Where do you see it going this year? Harry, can we kick off with you?
Sorry, could you repeat the question, please?
The UK has been unloved for some years now. Do you see this changing?
Sorry, on a what? I didn't catch that word. The UK is on a...
Unloved? Just not looking attractive to investors at the moment.
Okay, well, I sort of fundamentally disagree with that. And from a perspective of a smaller company investor, actually, the UK is an attractive place for the long-term investor. We see last year we saw a reasonable number of companies listing on the market, and we see companies that we invested in or listed 4 or 5 years ago continue to do well. It's a vibrant place. Our largest holding, for instance, Kainos, a digitalization company, continues to come through strongly, and the London Stock Exchange is still a good place. It's a pro-business environment. There's a lot of entrepreneurs about. There's a good network of private capital helping these companies. So we see it as a good place. Possibly a larger company market. There's a lot of companies that have been around for 20, 30, 40 years, maybe a bit last century in terms of their structure, but the smaller companies market, I would say, is very different, and returns have been good. And obviously there are certain setbacks in markets. There are bear markets, but I think for the long-term investor, it's a very attractive place. Sure,
thank you. And your thoughts, Samantha?
Yeah, I think, part of it is, to Harry's point about, some of the larger constituents of the index are the big names that have been around for a long time, and they're also more of what you would consider to be a more kind of a value skew, and value has been out of favor had been up until not too long now ago, out of favor for quite a while, and so that was maybe driving a bit of kind of the, as you would say, kind of unloved nature of the UK market. But having said that, stepping back, we look to invest in the fundamentals of the business, and we don't necessarily have to invest in any of those big constituents of the index. We don't have to invest in them we invest in the companies that we like, and we tend to invest in companies that have strong structural growth, strong competitive positioning, and all of those really good dynamics that have growth within them as well. So, and they're all present in the UK market. There's plenty of them to choose from. So we think that whilst the headlines can look as though they're big, stodgy companies that don't really move and, kind of are old school, there's certainly a lot of innovation and a lot of very exciting companies to invest in the UK, whether that's in the smaller end of the range, but also in the bigger end, and not maybe in the mega caps, but there's some there that we like as well. So I think there's certainly a lot to like. And if you look at it from a valuation perspective, it's still, much cheaper than a lot of other markets that you can invest in. And you're seeing that with, activists coming in and trying to take advantage of the market and the opportunities that they're seeing. And as you can see, we have really strong governance structures. We have less family ownership than a lot of other countries. So you actually can make a difference. And we engaged with companies all the time to get them to kind of improve and move forward in the right direction. So it's a great market, actually. So I think it's very interesting from that perspective.
Sure, thank you. And James?
Goldstone.
Yep.
Yes, I mean, I would agree it has been unloved, and I think that really, you could date that back to Brexit, and since the referendum, the UK market has been an underperformer of its international peer group. And whilst the referendum was seen to be, and in many cases did actually have some impact on domestically focused businesses, and so there may have been some logic to domestically focused segments of the market perhaps being under pressure. It's been much broader than that, and there are some almost entirely international businesses that have since 2016 dramatically underperformed their international peer group. So I definitely agree it's been unloved, and on one hand it's been a frustration, but then on the other hand I think we've seen that as an opportunity. You've had to be patient. It's gone on for some time, but I think towards the end of last year there were signs that perhaps that was beginning to normalise. And some of the both domestic businesses like I know Barclays had a reasonable performance last year and was quite strong into year end, and actually also some of the more international businesses like Vodafone or BAT also saw a re-rating. So we've definitely observed it. We've seen it more as an opportunity. And I think maybe the final point I'd make is that with what's happened more recently and the very rapid rise in commodity prices, given the weight that oil and mining have got in the benchmarks, in the UK benchmarks, I guess to an international investor that perhaps looks quite attractive now, given what those high commodity prices are likely to do to earnings, cash flows, dividends, and so perhaps there's another reason now that international investors will focus a bit more on the UK market. But we certainly think there's an undervaluation. We think that's quite exciting, actually.
Sure. And just on that note, you actually hold some energy companies and some in your top 10. How have they responded to the recent price hikes?
Do you mean the oil companies? Well, I guess it's a commodity. They're price takers. They're not price makers. They're operating already at the capacity that they're able to operate at. So I'm not sure there's a huge amount that's within their control in terms of suddenly ramping up production to take advantage. And in fact, that's true of the global sector. There is it would appear pretty limited spare capacity. I think the reaction that you'll see if these prices are sustained is probably going to be focused on returns of capital to shareholders, and they've already got dividends that represent really attractive yields at current share prices, more attractive still now that energy prices have risen. And if you look at the capital allocation frameworks, they've already laid out what their intentions are in terms of returning surplus capital within constraints that are set for the balance sheets via special dividends and buybacks. So it could be quite a rewarding time, I think, to be invested in those stocks.
Lovely, thank you. Just going on from that, Harry, back to you. How important, if at all, are macroeconomic considerations when you're assessing stocks for portfolio inclusion?
We really do not concentrate on the top down. We're bottom up investors. We look at the individual companies. What we found over the years is that sure, the global macro factors do influence companies, particularly at the larger end, but actually it's very difficult to predict. You can see economists, for instance, and strategists have a range of views covering every part of the spectrum, and they're probably right about 50% of the time in picking great stocks that are long-term winners, that have quality, that have earnings revisions momentum, and that have growth, and that are the larger companies of tomorrow. And generally speaking, our process has worked it has worked in the long term. There are occasions where it doesn't work, when the market just concentrates on the global macro position, but actually they do come back to looking at the stocks, what's going on within companies, and they generally do that around the reporting season, which is right now and into April. So we're quite hopeful.
Thank you. And James Burns, as a fund selector, do you think about, when something happens on a sort of macro scale when it comes to selecting your managers? What's your process there?
I think that for us, the macro considerations are certainly important in terms of where we're going to allocate money to. But within reason, if we allocate to the UK and there's a shift in favour to maybe like James with the oil companies, we are almost sort of giving that decision down to our fund managers to make, as opposed to us, following a manager or switching into a manager who's got a large allocation to oils, because that could change relatively quickly. So for us, it's more of the top down, allocating to regions and areas, and then just picking managers who've got excellent long-term records of producing the goods for us in various cycles, and letting them do their work there. I mean, my one question for the panel is, we talked about the UK market, certainly looking cheap compared to others, driven by sort of the post-Brexit hangover, and we've seen M&A being pretty prevalent across the market cap spectrum. I just wondered if there's any sort of feeling in terms of, do you think that these are quite good deals, or do you feel that we're getting companies stolen off you at bargain basement levels?
Samantha, do you want to start off?
Yeah, there's not been a lot in our exposure in Digit here, but in the market more generally, we're certainly seeing some companies come in and take one over others, or whether that's things that actually go through, or things that fail for whatever reason. And there's lots of moving parts generally that you can think about these things. Obviously, you had Glaxo looking to take out, Unilever looking to take out Glaxo's consumer health business, and that kind of was pushed back again, and so that didn't happen. But yeah, and that you could look at it and say, well, the overall price was a good number, it was a high number, and you don't know how the spin is going to trade. So how is that good or bad? But then there's other things to take into account. As a Glaxo shareholders, you'll then end up with Unilever shares. Do you want Unilever shares, or do you want Haleon shares? The tax considerations are also there. So it's not necessarily as obvious, and it depends on what you're looking for from your holding. In other instances, you'll see someone come in and capture some of the value. We've seen in some smaller cap exposures. We've seen some private equity come in and take out businesses that after they've gone through a particularly distressed time, and you get some of the value in the premium there, but ultimately, had they been allowed to operate on their own for a longer time period, then maybe they would have gotten there by themselves plus some. So it depends, but you get that money now and you can reinvest it. So it depends on what to put the rest of the money into. So it's it varies, and I think you just kind of take it on a case by case basis.
James Goldstone.
I mean, I would agree we're not shareholders in either Unilever or Glaxo, but I would agree that which was probably the biggest of all the deals that have been attempted recently was certainly a full price, and in the end that was probably the issue that was meant that it seems to have gone away for them. The one that we've had was Ultra Electronics. Again, we felt that was a good price. It was certainly a big premium. And so I can't say that we've had experience of anybody trying to steal assets away from us. But as I say, it's only really ultra that we've had in a portfolio in very recent times. Some of the other mandates that I manage saw some activity last year, and again, having spoken to the management team where they were recommending that shareholders accept the bid, it made sense. So I can't say I've yet experienced one where it just felt like the price was completely wrong.
Could I just say, I mean, we hardly ever see bids for our companies because they generally look on the expensive side, but we have seen certainly three in the last 6-9 months, San, Sumo, and more recently the Clipper Logistics. And particularly with the market falling quite sharply in recent months, there's no question to me that the private equity firms with all their dry powder are sort of running the slide rule quite widely over UK companies. I had a software company, actually, I won't name them, but earlier on this week he said he felt vulnerable. He felt vulnerable to a bid. And this is quite the shares have come off quite a bit, but there's still a decent rating. So I was really surprised at this. Lots of approaches going on, and we don't hear about. So another reason to feel that maybe the UK market, particularly the small mid-cap end, is a little bit on the low side.
Sure, thank you. There's been a lot of talk about a Brexit dividend, and while it seems elusive, do you think, Harry, that UK small caps, which are perhaps more nimble, could be well positioned to benefit?
I'm trying to think, has it really made that much difference? I mean, remember that our small mid caps they're called small mid caps, but they're actually quite decent sized companies making perhaps hundreds of millions of sales or tens of millions of profits, and a good number of them are quite international. And in fact, I'd say around about half the revenues and profits of our companies come from outside the UK. So they are able to thrive, and I think this nimbleness is definitely the case. It's difficult to get a juggernaut super tanker to turn around quickly. They've got all this invested capital in infrastructure, established business methodologies. So when the internet comes along, and I mean, this is the story of the last 15-20 years, new business models become apparent. Smaller companies can very quickly take advantage of that.
Sure. Samantha, you have quite considerable exposure to large cap stocks, but there are some small cap positions, such as Pets at Home, in the portfolio. Does the focus on larger cap stocks reflect the trust income requirements, and what would a smaller stock need to offer to make the cut?
Yeah, so we have about 30% in kind of what do you say, small and mid kind of companies. Typically, what we're looking for in this trust is for sustainable income above the market, plus growth of that, plus total return. So we're looking to grow the capital as well. And often you will find that your real kind of capital growth, but also sometimes your dividend growth will come quite a lot from those smaller companies. So they might be smaller yielders in absolute sense, but their earnings growth and their cash flow growth and support of that dividend going forward is very strong. And so having a nice exposure to that allows us to balance all of our targets.
Did any of your portfolio that had to cut or suspend their dividends, would you say they're fully recovered, or is there still more to go?
There was a certain amount of people who did, with kind of the uncertainty with COVID, pull back on dividends, but then once it became clear or they had better visibility, they would have reinitiated them. That was broad. That's a more kind of a broad comment. We've actually, because we have a sustainability overlay with this fund, we once we implemented that, we had to trade out of some stocks that were no longer would be, appropriate for the fund, and so we had kind of a bit of a change in the dividend structure as a result of that when we invested into other things. But that was more of a factor than anything else, I think, going over time.
Sure, and James Goldstone, same question to you. How's dividend cover looking in your portfolio?
Well, there's certainly been disruption, and there were a number of companies that either cut, i.e. reduced, or completely suspended dividends during the pandemic. On the whole, I would say operationally, the companies that we're exposed to have recovered very strongly from COVID, and in a number of cases, the dividends have just normalised. But it is a mixed picture, and that there are others where they've reinstated, but at a lower level. So actually, BP and Shell would fall into that category, and for different reasons, not COVID related, those dividends are not going to normalise. They're prioritising investment in renewables, and they've found other uses for the cash flow, so they have a new rebased dividend policy. There's another group where they haven't yet reinstated the dividend, and typically the sort of consumer cyclical UK exposed names, for example, Restaurant Group, which have only bought post-pandemic, but they still haven't reinstated the dividend. Whitbread, which we've had all the way through, and Johnson Service Group, are two others that haven't yet reinstated dividends. But just looking at the operational performance of the businesses, as I say, there has been a good recovery, and given the characteristics of those businesses, which pre-pandemic, we're always cash generative. We'd like to think that in the not too distant future they will be reinstated. So lots of disruption, but at a portfolio level, with the gearing, the yield on the trust is effectively in line with the index, and then historically the board have chosen to top up those dividends that the portfolio has kicked off from capital, and so that's a decision for the board. But I think we think that the portfolio yield is currently very competitive, and probably still some recovery to come.
James just mentioned gearing now. So that was going to be my question for all three of you was, where are you in terms of gearing today? And did you did you see the sell-off in the markets a few weeks ago as an opportunity to actually increase that and buy some pretty attractively priced companies? Do you want to go first, James?
Yeah. So we're currently geared around 10%. We think of 10% broadly as the neutral rate, because it's halfway between 10 and 20. We have a framework that we use to help us steer through volatile times. We haven't changed it very recently. The last thing we did was to reduce gearing, which we did do ahead of recent weakness. We haven't yet taken it back up, but it's something that we constantly monitor.
And Harry?
Yeah, gearing is about, we don't have a lot of structural debt. We have a maximum about 8%, and currently we're geared about 4%. It is one thing I do find difficult is actually predicting the month-to-month direction of markets. I think that's quite a challenge, and we certainly saw an extraordinary turnaround. In terms of value and growth at the tail end of the year, really quite dramatic. So we're retaining at 4%. We have a war in the Ukraine going on. We have interest rate issues in the US. It's a little. It's hard to pick the bottom of the market, isn't it, in terms of gearing? So I suppose right now we're sitting on the fence a little in these volatile times, and we think that investing half our debt is appropriate right now. But we are alive to changes in the situation in the short term.
Thank you. And Dunedin income growth?
Yeah, so we have a maximum limit that we would kind of go to is around 10%. We're under that at the moment. We're more like high single digits. We use it, as a kind of cover for the options that we write. We generate about 10% of income from options, and we use it to kind of strategically get to positions that we would otherwise like to have and just generate some income in the process. So it's kind of a very low risk kind of option strategy, and we use it for that. We could draw it down to buy more stocks in the market, but we haven't felt the need to do that. We've actually felt that we could strategically, or maybe it's more tactically pick up some of the names that have underperformed in this market and sprinkle some of the money into those stocks and take advantage of that. And we felt like we haven't necessarily needed to go further than that, and we kind of think that debt at the moment isn't expensive, but we have had higher leverage in the trust in the past. And it's not necessarily something that we think that our audience is looking for necessarily. So we're kind of happy with where we are.
Sure. The discount on Dunedin has narrowed significantly over the last year, so much that it's been trading on a premium and you've been able to issue some more equity. What do you think has driven that?
So I think it's a combination of things. We, certainly looking back, our long-term performance is strong. Look at the 3 and the 5 year numbers. Obviously, it's been a lot more tricky in the recent market rotation. So that's been a harder time for us given our exposures. But I think when you look at what we're actually trying to do and what the fund offers, it's a long-term quality approach with above market yields, target of above market yield plus capital growth. So it's a total return portfolio that is primarily invested in the UK, but can have 20% of the exposure to outside the UK, which we typically have in Europe, where we can get some nice stocks where we prefer the dynamics of the business and the characteristics of them versus what we can invest in the UK, and whether that's just from an overall quality perspective, but also from a yield perspective. And then also it has this, sustainability overlay. And we think that's important because, when we think about sustainability, there's lots of aspects to that. But at the end of the day, these are risks that the company is exposed to. And when you look at the companies over a long-term period, these sustainability risks are economic risks as well, whether that comes in the form of, long-term demand for their products or fines, exposure to reputational damage. All of these things can impact the company over the long term, and that impacts, total return, but also, dividend growth over time, cash flow predictability. So, we look at it holistically, but I think those things, in terms of what the fund offers, is really it's kind of somewhat sets it apart. So I think that's all a contributor to the premium.
Thank you. You mentioned sustainability there. This is a question for all managers. Do you have an ESG policy, and if so, how does it work, James?
Well, I would echo a number of the things that Sam just said, and I think clearly ESG has been a huge focus for the market. It's become a huge focus, and it looks like it's only going to increase. It's become, in the last 2 or 3 years, a very obvious driver of share prices. But I think it's worth saying that even before we'd heard the phrase ESG, this idea of sustainability and also of governance and stewardship is something that both Kieran and I, as managers, before we came together to jointly manage funds, when we were just managing our own separate portfolios, have always spent lots of time thinking about and talking to companies about. And it's also, these are 2 issues that Invesco as an organisation has also always taken very seriously. So we now have a global ESG team, and so they will separately engage with companies. We also on the UK team have 2 specialists who handle all of our UK engagements on our behalf. Lots of that around remuneration, but broader ESG issues as well. And so it's it's one of the issues with ESG is that the amount of data out there and the number of variables that you're trying to assess companies on is so vast, and in many cases the quality of data isn't great. That I think I can speak for Kieran and certainly for myself in saying that we're very grateful to have that extra resource, because I think otherwise it could potentially be slightly overwhelming. So it's an area that we're very focused on in terms of a policy. The policy on this trust is that we have integrated ESG into the investment process formally. But as I say, that is really just a continuation of what we've always done, and just thinking about sustainability more generally. And as Sam said, when we're making an investment, along with all the other areas of just the fundamentals of the business, we've always been very focused on sustainability, because if you're not, then you end up tripping up and finding that the earnings base or the dividend base that you thought you were buying into has just been undermined. Yeah, it's integrated into the investment approach, probably more so than ever, but it's just a continuation of the approach that we've taken over many years.
Sure, you're right in that there's so many factors and variabilities to think about when it comes to ESG. I think on the surface there's some that, and you might just think that because it's, it might be BP or Shell or whatnot. You have some of those in your fund and in your top 10. What would you say, of course they pay good dividends, but what would you say to an investor about why, how companies like this are changing? And can you talk about your engagement process with those kinds of companies?
Well, I think the oil companies are a good case in point. And perhaps I should have said a moment ago, actually, in terms of the approach that we take. We're looking very much for improvement rather than perfection. So, I think we're trying to be realistic. The world is the way the world is. There are certain imperatives that have been set, and it's a question of how these companies, which are so central to the economy and such big drivers of the market, can adapt to help to deliver that change. And rather than an exclusionary process, because there might be a view that what they're doing at the moment is bad. We're much more interested in engaging with them to understand how they're going to address issues both that exist today and over time. And I think in the case that you take BP, that rebasing of the dividend that I talked about earlier was in order to afford a $5 billion a year spend on renewable energy. So I think there is tangible evidence that the companies are taking this seriously. They've got to, because if they don't, these objectives can never be met.
And Harry, in the smaller companies market, how do you approach ESG and those sorts of areas?
Okay, well, I'd echo a fair amount of what's already been said, but likewise, we have an ESG professional on the smaller companies team. We do engage with companies. We do try and influence policy in terms of all aspects of ESG, be it corporate governance or carbon footprint or relations with employees, and companies do listen, and they are looking for guidance. And actually, our in-house team can help them formulate and structure their ESG policies, which is quite productive. In terms of oil and gas and mining, I mean, small companies we find actually historically that we've really been pretty underweight in these areas for many years now, because from a risk perspective, mining and oil and gas don't look good in small company terms. They tend to be in parts of the world where the rule of law doesn't run. They're cash consumptive. They're quite often pre-profits. Their development. They just don't fit with our investment process. Full stop, really. So that's kind of it on ESG.
Sure.
I was just going to ask, in terms of the last couple of years where we've seen markets have been pretty volatile, I'm sure all three of you tend to sort of invest in companies with a longer term view in mind, but have you found yourself being more active in the last 24 months rather, by virtue of stocks moving around that much more? You've been doing more to the portfolios than you might normally have done. Harry, do you want to go first while you're there still?
In terms of more active in it, we certainly, I suppose, there are definitely more meetings with companies, shall we say, and I suppose part of this is it takes less time, but also there are specific ESG engagements. There's engagements with chairs. So we're reasonably methodical in terms of picking companies within our portfolios that require a bit of attention and a bit of prodding in terms of moving in the right direction in terms of ESG and engagement. So that has definitely built up in recent years.
I guess in terms of turnover of what you've been doing, has that picked up?
Turnover in the portfolio has turnover in the portfolio is fairly standard over the time. I mean, we clearly when we have a lot of our companies get promoted into the large cap world and become too big for in market cap terms for our portfolios, we would tend to recycle the money into the next smaller companies, exciting investments that fit our investment process. But there hasn't been a dramatic increase in portfolio activity and turnover in recent years. No.
Sam, what about you?
So our biggest kind of turnover change was when we implemented, our sustainability framework. And so we knew looking at that, because we do have binary exclusions that we have, whether that's, a certain amount of revenue from weapons, from unconventional oil and gas, from thermal coal, or from tobacco. Those are some of them. We also have a house score on ESG, which our in-house ESG team develops from an operational and governance perspective. Those are the kind of the two broad pillars, and then that score will rule out a certain proportion of those that don't meet the threshold. So when we looked at how this overlay would affect the holdings, we knew we would lose about 12% of the capital and about 16% of the income from applying it, which we thought was just broadly the right thing to do. So we did take out some of big names that kind of were in those buckets that were high income generators. And so we wanted to do that without actually changing the risk profile of the fund too dramatically. Which we did manage to do. So we just invested into other areas. But what happened was, some of those were high variable income generators as well. They have variable payments for their dividends. So that can cause a bit of change in it. But actually, we had a more kind of sustainable and visible dividend profile moving forwards that was good. And we could invest into similar stocks that have maybe a more renewables kind of aspect to it, or good European stocks. We switched out of some mining stocks into, say, Nordea, which is a very solid mid-single digits earning growth bank with very strong capitalization and very good yields. We have Persimmon, which is a very high yielding stock, which allows us, there are other stocks that you can invest in that have high income that, that means that, whilst you lose these higher income stocks, we think net will be a beneficiary in the long term. So that's more of the kind of changes that were made in the portfolio. Other than that, it is quite standard, trimming things that have performed and investing in things and dripping some money into things that have underperformed that we still really, really like for the long term. So it's very much post that change, very routine.
And James?
I think the short answer is no. I mean, Kieran and I, when we've managed portfolios separately, my average holding period has been over the long term about 3.5 years. Kieran's has been longer than that. We only came together on Select last April, and so it's too early to give a number because it would be meaningful over such a short time period. But I think if our investment horizon is 3 to 5 years, it's probably realistic to expect the average holding period to be somewhere between 3 and 5 years. And clearly there are, echoing some of the things that have already been said, there are situations where things change for better or worse, much more quickly than perhaps you'd anticipated when you made the investment, and we'll always try to be active and if we need to change then a position, then we will do it sooner. And then the other thing that can produce maybe slightly higher turnover in the short term is just, when you're at big macroeconomic or market turning points. And whilst there has been a good deal of volatility, I'd say over the period you've asked about, James, no, we've largely stuck with what we've got, and I think that's probably what you'd expect, given that it is very much a bottom-up driven process. So it's only really when the stock specifics change materially that, in most cases, that we look to change a position.
Sure. I know you follow a bottom-up process, but you mentioned, the idea of a macro turning point, which we could well be seeing with rising inflation and interest rates. Is that a concern at all to you?
Yeah, I mean, it's something we're looking at very closely, and in fact, we're looking at through the second half of last year, because inflation's been building for some time, and it's been broadening, and it's found its way into wages, and it's an issue that we've been considering for a good deal of time. I suppose you could say that last year's inflation might have been good inflation because it was the result of the very strong economic recovery post-COVID. There were tinges of perhaps less good inflation because that very strong recovery was into an economy where there were some bottlenecks, there were some supply constraints, but generally inflation reflected just the strength of the strength of the economy and the strength of the outlook. I think it's probably fair to say that in the last few weeks, where it's been very, very commodity-led, and I'm sure we've all followed the oil price and the prices of other commodities, we're now perhaps at risk of some less good inflation, because it's going to be inflation in non-discretionary items. So it's something we're looking at really closely. Obviously, we had the FOMC just last night, and the Fed do at this point, they're committed to a series of interest rate rises. There are now somewhere between 7 and 8 priced in for this year, and I think that's a bit of a tightrope that they're walking. And if they can control inflation and not damage demand and not tip us into recession, then I think that will be a great achievement. But as ever, at these turning points, there are risks in both directions. So watching very, very closely, but it is predominantly a bottom-up process, and it would only be if we were convinced that there was suddenly a sort of major change underway that we would then sort of give macro a slightly bigger weighting in the process and in the things we're thinking about than normal. I just don't think we're quite there yet.
Sure. Rising inflation and interest rates tend to have a negative impact on growth stocks. However, a counter argument might be that decent growth is a good defence against inflation. Harry, would you agree with that? And what sort of levels of growth might you hope to see in the portfolio over the next few years?
Okay, I think there's two aspects of it. I think it is true to say that in periods of rising perception of inflation, that valuations of predictable growth stocks come off, and they certainly have come off in the last 3 months, really quite dramatically, without any bearing on the underlying trading of these companies. In our quality growth momentum oriented stocks are virtually all trading extremely well, but valuations have come off. Their growth prospects have not come off. So that's one aspect of it. I think we're through that. I think where we are now is that if rising inflation, if we get stagflation, get an actual recession as a result of all these interest rates rises that are predicted, then our companies, our quality growth momentum companies, will actually thrive, because we do find that our companies do well in the hard times, and we always find that the strong get stronger through hard times, and the weak get bought out, they go to the wall, they cut their dividends. And so actually, in that respect, we don't feel we have anything to fear in the long term by a rise in inflation. I think we just stick to our investment process, and what has happened in the last 20 years should continue. regardless of the level of inflation.
Sure, and Sam, your thoughts on inflation and interest rates at the moment?
Yeah, I mean, obviously, the rising rates, rising commodities, and inflation is quite good for some aspects of the benchmark. So whilst you've had, these companies that have underperformed for a long time, they're now outperforming because we've had this rotation, but also because their earnings are more supported than they were before. And we typically would be underexposed to those kinds of businesses. So that's kind of a difficult environment for us as a trust to be in. But having said that, that's the strategy that we're operating in, and that sustainability overlay impacts that, as well as the quality overlay that we have as well. So that's kind of where we still think is the right place to be in the long term. And when we step back and look at our companies and think, similar to what Harry was saying, really is that these companies find their multiples have come back because the discount rates of that are being applied are changing how you look at those durable cash flows. But actually operationally they're still growing the same way that they were. They're still able to pass on pricing because they've got strong pricing power and strong competitive positions within their markets. So we're actually seeing, as the results kind of filter through, companies are saying, yes, we're seeing pressure on our cost base, absolutely. But because we're able to push pricing here strategically in these positions, we know our markets very well, we're able to push these aspects, and we manage our businesses very well. So we hedge where we can. And so, for example, with something like a Diageo, they have a massive proportion of their products are aged liquids. So, really the commodities that they're putting into their products, they don't have to get that pricing coming through for 10, 12 years. And if a 10-year bottle isn't selling the way you want it to, you keep it for another 2 years to sell it for an even better price as a 12-year. So there's only actually for those companies, it's a lower exposure to actually have their cost base than you would think it is. And so therefore the pricing that they have to take on the other end isn't as high as you would expect. So they can have some impact on that and offset it. So I think broadly speaking, valuations have come back. So whilst we're looking now at implied returns kind of in the mid-teens versus before, high single digits. So I think we're pretty happy that the environment is now getting to a position where we're more looking a bit more optimistically. We're generally always a bit concerned about everything. I think that's part of our job is to look at these things and kick the tires and be worried on behalf of our clients and try to make sure that we're covering off all those bases. And I think all that we can do is make sure that we do invest in quality companies. And so we can rely on them to perform well in almost any environment and have the strong balance sheets to withstand difficult times. So that's what we really focus on is that performance operationally of the companies and good management teams and good strategies.
Thank you. James Burns, do you have any thoughts on that?
In terms of the
rising inflation and interest rate.
Yeah, it's obviously something that we've been keeping a close eye on, and part of the reason why in the portfolios I run, we were increasing our exposure to more value type parts of the market, be that the UK in general, or managers in other areas which were more geared towards that style, because we just felt that it's lots of companies will do very well over the longer term, but at some point you want to have some of those companies which have struggled in the last almost decade, and this could be the time to actually have a few of those in the portfolio, which are cheap and might do better in an environment where interest rates and inflation are going up. But we tend to be fairly balanced with what we do.
Sure, thank you. More of a fun one. Can you talk about a stock that's driven performance of the trust year to date and that you're most excited about at the moment, James Goldstone?
Well, the biggest contributor that we've had year to date has been Barrick Gold, and obviously that's a US company. So perhaps we're saying with the trust we're allowed, I think, responsibility to invest up to 20% overseas. In practice, we'll only do that when it gives us access to something that we can't get in the UK market, and that's certainly the case with Barrick. Echoing some of the things Harry said earlier about the UK mining sector. You know, our requirement for a mining business is that it's large, it's diversified by geography, it's diversified by asset, it's got a low cost base, it's cash generative, it's got a strong balance sheet, and we just couldn't find anything like that that gave us gold exposure in the UK. So we looked overseas and we bought Barrick and in fact Newmont. Now Barrick and Newmont have performed well as the gold price has performed well, which you would have expected, you know, if you'd known that we were going to have the disruption that we've just seen, and you know, weakness in the indices. Well, I would have predicted that Barrick and Newmont would have outperformed. They are the gold price itself is historically inversely correlated with equities, particularly in the tails. So we really like the diversification that brings and the protection, if you like, that when there's a broad equity market sell-off, you've got a part of the portfolio that can actually go up, and that's exactly what's just happened. And I think perhaps just tagging on to the end of the inflation and interest rate questions and answers a moment ago, you know, there is a lot more inflation than we've seen in many years, and you know, despite the interest rate policy that appears to be the course that the central banks are going to take, which is interest rates are going up, they're still going to be significantly below, for the foreseeable future at least, the rate of inflation. And so with that negative real interest rate, again, I'm not surprised that the gold price and the gold companies are responding well to that. And in the case of Barrick and Newmont, you know, that balance sheet strength and that high free cash flow yield, they've got really attractive dividend yields just at the spot gold price. So I think if the market is beginning to see the attraction of gold, it is beginning to identify in those two companies a pretty defensive and in terms of the dividend rewarding way to get that exposure today. I think that's probably what's happening.
And Sam, who's your star stock at the moment?
It's hard to pick one. You know, I think that from a performance perspective, I mean, we've definitely, you know, there's been not holding a certain amount of things has really kind of dominated our performance in the kind of more recent term. But if I look at kind of the positive things that have helped us a lot, it's been, we have exposure to Total, which has been strong during this period. We like that stock. It's our kind of only direct energy holding. And then we have other kind of offsets in terms of indirect exposure. Weir has been doing very well recently. It has oil and gas capex, mining exposure there. More on the capex side, so it's a different kind of part of the cycle. But and we have Aveva, which has been, you know, really hard hit recently, but is, you know, we really like in the long term and find that and think about that stock quite a lot as a strong position. Other things that we have quite a lot of, we have good position in AstraZeneca. Their oncology portfolio is fantastic. They've got a diversified asset base there. They have really kind of blockbuster drugs, like quite amazing what they've been able to do under Pascal, the CEO, and kind of take that business, which was, you know, facing a really substantial patent cliff, and then he came in and kind of refocused the business and found some amazing assets that kind of were diamonds in the rough that they had in the portfolio that didn't know that they had, and then also do some really good strategic acquisitions and some disposals of lower growth assets. So they've really got a great portfolio now of a series of blockbuster drugs that are still in ramp mode. Plus, they have a really strong pipeline as well. So that's a really good stock, and I think that it's not expensive for what it is. Diageo is also a favorite of mine. They also went through tough periods in their history where they had a more vodka-based portfolio of assets that are more commodity like, and now they have just a really strong collection of really strong brands that range from, you know, Johnny Walker whiskey to Kettle One to Gordon's to Tanqueray, you know, all the stuff that you really know really well, and then they also have a really amazing high-end super premium tequila portfolio, which is growing really strongly, and they're just a marketing, advertising, promotion powerhouse with amazing digital insights they've also kind of developed in-house, and they've got they're doing strong dividends. They're doing also a really big buyback program because they generate so much free cash flow, and they're in this kind of virtuous cycle of taking efficiencies and growing the margin. And they don't have to grow more than high single digits in the mid to high single digits in the top line, but they can convert that into what is going to be kind of 10 to 15% earnings growth plus dividend plus. So I think it's an very interesting stock, and one that we're kind of excited about.
Brilliant, thank you. And Harry, same question to you.
Yeah, I'm just going to mention a stock that's just been in the portfolio for half a dozen years anyway, but rather mundane. Self-storage. It's called Safe Store PLC. It's getting a bit big for us, but it's just it's interesting. It's run by this enigmatic Frenchman, Frédéric Vecchioli, who kind of lives and breathes self-storage. I don't think he's got anything better to do with his life, maybe. But it's in the UK and Europe is way, in terms of the use of self-storage, is way behind the US, but it is growing, and it's growing steadily, and particularly in large urban areas like London. So SafeStore is now pretty much the biggest in the UK, and particularly concentrated in the southeast. But Frédéric Vecchioli joined when his company, which is Paris-based, was acquired. So 20% of assets are in Paris. They've recently opened up in Madrid, in Barcelona, and also in Benelux. So what we quite often like is a stock that's doing really well in its home market in the UK, but is enabled to expand internationally. And this really broadens the scale of growth and earnings power. So it's a long-term story with an international tinge, which we really like.
Brilliant, thank you. We've absolutely flown by the last hour, so I think we'll have to wrap it up there. Thank you so much to all the managers and to James for joining us today. And thank you to all our viewers. If you want to look back, you can watch this over again on our website. And I think we've got some links that have just been posted into the chat box where you can follow through to find out more information about the trusts that we've spoken about today. Yeah, thank you very much, everyone, for joining us.